In this episode, we speak with Zia Uddin, president of Monroe Capital, a premier asset management firm specializing in private credit markets across various strategies, including direct lending, technology finance, venture debt, alternative credit, structured credit, real estate, and equity. Since 2004, the firm has been successfully providing capital solutions to clients in the U.S. and Canada. As of January 1st, 2025, Monroe had $20.3 billion in committed and managed capital. The firm is headquartered in Chicago and maintains 11 offices throughout the United States, Asia, and Australia. Zia has over 30 years of management consulting, corporate finance, private equity, turnaround, and investing experience. As president, Zia focuses on Monroe's day-to-day and strategic long-term growth initiatives. He also assists in both Monroe Capital's software, technology-enabled, and business services lending, as well as the firm's independent sponsor activities. Zia's experience includes past and present roles as a board member of various public and private companies. He joined the firm in 2007 and is a member of Monroe's investment committee. I'm your host, RJ Lumba. We hope you enjoy the show. If you like the episode, click to follow.
RJ Lumba is the managing partner of Growth Cap and the executive chairman of Market Insight Media. He is the host of Growth Investor, a podcast featuring today's best investors, executives, and founders. In the minutes ahead, we'll uncover insights and strategies for accelerating growth and succeeding in business.
Zia, thank you so much for taking the time to chat with us today. It's a delight to be with you.
Thank you so much.
This is coming at a great time, this interview. You know, private credit is on the rise. Recently, your firm did a strategic partnership transaction at the tail end of 2024. We'll get into the history of the firm and how it's grown, but maybe let's kick off with your partnership with Wendel Group.
Sure. So as you pointed out, we made an announcement last year. Wendel's a French investment firm. They've been around about 320 years. And what was interesting for us in that partnership is, if you look at the history of the firm, which we'll get into, there were a list of things that we wanted to accomplish as kind of a strategic partnership. And so one of that was autonomy, so allowing us to run the business. So they check that box. One is capital. So as the firm gets bigger, having more sources of capital to seed new strategies to fund GP investments was a big part of the value proposition. C, as you probably know, they're headquartered out of Europe, out of France. So there is some synergies there. We have LPs in the region, but having a parent company in the region, I think will add some strategic value as well. And then the last part was really incentives. So the way that deal is structured, a lot of the economics are still with the Monroe entity. So it allows alignment with the LPs for, the next generation of leadership and so on. So, we talked to a few folks, but it's very difficult to pull off a deal. And a lot of it is, culture. It was very important for us to maintain our culture, as well as kind of the capital piece of it and the autonomy piece. And so when you whittle down a lot of these items, then you kind of are left with a few people, and they were the ones that had the best fit.
One thing that's apparent with Monroe is your ability to create maybe new types of investment vehicles, new products. Presumably, that's something that they found really interesting, compelling as well. So maybe that's a lead in to tell us about how Monroe has evolved from when you joined all the way to present day.
Yep, for sure. So the firm was started in 2004, although the founders had worked together in a previous firm before that, but officially Monroe was founded in 2004. I joined in 2007. And back then, the market was very different. I mean, private credit is a very big thing today, $1.3 trillion or whatever the number is right now. But back then, it was a very different market in that people understood private equity and they understood liquid credit, but they didn't really understand private credit because you have these closed-end vehicles. So they never really understood where to put us. So although we've been doing the same thing for going past 20 years, back then the market was very different. But the founders, Ted and Mike and Tom, the idea was, well, how do we become different? And so what we didn't want to do is be people call it beta alpha, I think both terms are used too much, but we didn't want to be like everyone else. So we didn't want to be the large players out there because at the end of the day, that's a commodity. And why would LPs pick us? It's if they want that exposure, there are great players that are very large. So what we try to do is figure out, okay, how do we differentiate ourselves? And so we did that in a few different ways. One was our chief credit officer, Mike, one of the founders, he came out of an asset-based lending background. And if you know anything about asset-based lending, it's very deep diligence. It's very heavy monitoring, bottoms up fundamental analysis. And those are the techniques we said we're going to apply to the lower middle market. So companies under 40 million EBITDA, which is highly fragmented. Nobody has any significant market share of scale. But if you can use those techniques in this inefficient market, we should be able to generate premiums, and that should be an interesting product for limited partners. And so fundamentally, that's kind of how we started. So if you look at the growth of the firm, we've leaned into areas where we can leverage that core competency. So the core competency of fragmented, inefficient markets, as well as kind of this spin on bottoms up due diligence. You get paid to roll up your sleeves and figure things out versus, in the upper end of the market, not that there's anything wrong with it, you can buy paper and you're no different than the next person. So we try to grow the firm in very specific areas. And luckily for us, it's been successful and there's a lot of room to grow. The market, as I mentioned, is $1 trillion. We're at $20 billion. There's plenty of room for us to kind of grow in areas which we think we can add. And that's ultimately what we're trying to do.
Mm-hmm. And you seem to have certain focus on sectors. Can you tell us a little bit about which sectors you like to play in the most?
Yeah, so the market's very big. We do have specialists in software technology. We do have specialists in healthcare. We do have specialists in aerospace defense. The things that we tend not to play in, and maybe it's easier to talk about the industries we don't want to really be major players in, would be more of the commodities. So things where you have specialized lenders. So agriculture would be one, commodities, things that have a finite life. The obvious ones that are out of favor today are retail, right? So nobody I know admits, at least outwardly, that they're doing retail. But we tend to focus on business to business, core economy type businesses. So it's kind of basic things that are predictable and dependable versus kind of things that, in my opinion, you don't get compensated for that kind of risk, right? So if you're doing things that minerals out of the ground or some sort of commodities, there are factors that you just don't control. And so how do you price that risk? And so as a lender, it's difficult to kind of get into those unless you really know what you're doing, which, we don't have a dedicated team that just does agriculture or forestry or something like that. Down the road, if that's something we choose to do, we'd have to build that out. But to date, that's not been a focus for us.
Today you help lead a 20 billion plus asset management firm. You started out, I think, at Arthur Andersen, which we share that. I was there in the late 90s for a couple of years. Tell us about your background, where you started and how you kind of evolved your career.
Yeah, for sure. So I grew up in the suburbs of Chicago and I lived overseas for a bit. So I lived in Indonesia for about 2.5 years. I actually went to high school in South Korea, but I went to University of Illinois down in Champaign. So typical kind of finance major, did heavy accounting as well. And to your point, after undergrad, I went to Arthur Andersen. Arthur Andersen was a great training ground. So obviously a very large firm. For folks that didn't know it, it was probably one of the preeminent consulting firms in Chicago at the time, for sure. But you got to learn from very smart people and you learn techniques that today I still use. So you work at a very big organization and I tell a lot of folks, a lot of it has to do with who you work with and who your bosses are. And, what you do in the first few years of coming out of undergrad, it's interesting, but it doesn't dictate kind of where you end up. But Arthur Andersen was a great training ground, met great people. I'm still in contact with folks even 30 years plus later. So Arthur Andersen, we did a lot of consulting work, but across the board, we did litigation consulting. I started the economics practice with another individual. We did tax work. We did M&A work. So a lot of different things that you can touch that kind of builds a skill set that 30 years later, 40 years later, you realize, hey, I did this, and that applies to kind of what I'm doing today. So I did that for a bit, and then I left. I went to grad school at the University of Chicago, graduated from there, had a major in econometrics and finance, and then joined private equity. So I had done the consulting thing, and so I wanted to do private equity. So I did kind of middle market buyouts, kind of core economy type things, but I wanted to do more on the operations side. So I left private equity and became chief operating officer and chief restructuring officer of 4 private companies. So did a lot of M&A work, a lot of workout work. So the idea for me was, let's figure out and build a skill set and then apply that to something down the road. So I had done kind of the consulting thing. I'd done the private equity thing. I'd done working in a business from the inside. And then I ran into Ted, who's one of the founders, in 2007. And a mutual friend had introduced us. And we just had lunch, had a conversation. And then he said, hey, listen, you seem like a deal guy. I got this vision of building an asset management firm. Are you interested? And I kind of looked at him and I said, do you make money? And he says, well, we do this thing called private credit. I said, okay. And back then our returns were stellar and we had a CLO, which was shooting lights out. So, I did my diligence. I said, is this something interesting? And many things in life, I can't say that I had predicted we'd get to 20 billion. Don't get me wrong. But as I said before, you kind of look at things and you say, I liked Ted's energy. I liked his passion. The market I knew less about at the time. And so you're like, okay, it seems interesting, but I'm willing to take up with a guy that's passionate. And one thing led to another. So that was back in 2007. Historically, I ran our private credit book. So out of the 20 billion, it was, I think, 12 or 13 of that. And then about 4 years ago or around there, I became president. So today, I tell you, I'll probably spend a third of my time fundraising, mostly international at this point, a third on still investment committee things. So I sit on investment committee, things like that. And then a third is more strategic stuff. So the Wendel transaction, for example, we did an acquisition of a venture lender in 23. Obviously, I spend a lot of time on the hiring side. So in our business, to me, the biggest cost as well as the biggest focus, at least from my perspective and Ted's perspective, is the personnel side and the culture side. So I spend a ton of time focused on that as well.
Yeah, and we'll definitely touch on culture. What you've been able to accomplish with your partners is not an easy thing to do. There's a lot of people out there, hungry investment professionals, building their own firms that may never get to where you are today. What do you attribute kind of your firm's success to?
I mean, listen, number one, a lot of things in life, there is some element of being at the right place at the right time. So private credit, rising tides raise all ships. There is no doubt that was a tailwind. Having said that, I got to tell you, if you look at the partners that I work with, we all are slightly different backgrounds. Like you see a lot of the firms that they all come out of kind of one firm and they all kind of have the same DNA. And that's great. It works for a lot of folks, whether you're ex-Goldman or ex-GE or whoever, there's a lot of firms that are like that. Ours is a bit different. We've got, I think, a more of a multi-tapestry kind of approach. So, I came out of consulting, private equity. Mike came out of asset-based lending. Ted was a former lawyer and was doing the documentation for lenders and then started doing private credit. And we've got other folks as well. So to me, the biggest difference for us and why we've been successful is I think we look at risks pretty comprehensively. Because when I look at a deal, now I've been doing private credit since 2007, so that experience is significantly more than everything else. But when we look at a deal, I'm looking at it at a certain perspective. Mike's looking at it. Tom's looking at it. Carrie's looking. So we all kind of think that we vet the issues because ultimately what we are in the business of is risk-adjusted returns. Like there's risk in everything. If you don't think there's any risk, then just stick your money in a mattress and, cross your fingers. But what we're trying to do is have the highest risk-adjusted returns. And for us, you have to understand that risk. And in my opinion today is that's being lost because if you look at the last 10 years, 15 years, when most private credit firms have been around, everybody kind of has the same returns. And the reason for that is There's been no stress in the system. There's been no stress on kind of the process. I do think that's changing. You see that a little bit happening, but the way we've been successful is, one, I think we have a lot of different complementary skill sets all coming together. But two, and this is really the core DNA of the firm, our belief is nobody should outwork us. Like guts is something inside. People can be smarter than you, taller than you, wealthy, but guts is you. And so our job is to hire people that have a large tenacity and want to accomplish great things. And we'll give them the platform to do that, but you have to be able to bet on yourself. So we're not, in larger firms, you can kind of get away by being mediocre because you're lost in the shuffle. For us, it's really driven by being a meritocracy and making sure that things are transparent, things are flat, we are nimble. And if you are successful, you'll get rewarded. If you make a mistake, that's okay. The question is, how quickly do you move off of that? So everyone makes mistakes. If you're not making mistakes, you're not innovating, but you can't sit there and let things fester. And that really is, to me, one of the core reasons we have success. We've got a lot of smart folks that have that kind of DNA and that mentality. And, it has to start at the top. And when we recruit, these are the kind of things that we look for.
Yeah, just to take kind of culture a layer deeper, when you set out in your role with the firm in 2007, how intentional was it? Did you design, say, like, okay, this is what we need to instill, like this type of culture and environment in order to be successful? Was it organic? Did you kind of learn along the way as you were recruiting more people?
Listen, I would love to tell you that there was a master plan and we had a napkin at a restaurant that had all this mapped out. I would be lying to you. So we had an idea of the framework. Now, the specifics, a lot of it is driven by market. You can't fight the market. So where we are very good, as you look at the opportunities in the market, we knew what the core skill set is. So how can we take advantage of those opportunities, right? So I tell folks all the time when we recruit them, listen, I don't know what the market will be in 5 years or 10 years. I have some ideas, but I really don't know. But I'm confident that we have the folks that can figure it out, right? So whether we know this fundamental underwriting, the inefficient markets, the speed of execution, like these are all things that you could use in kind of different places. And that's been kind of our focus. So going back to your original question, did we have a master plan on how this would grow? No, I think part of it, and you got to remember something, the firm was founder led for a long time. In the last 4 years, 3 years, as long as I've been president, what I've been focused on more is, okay, we got to 20, but we want to get to 50, 70, 100. We see this in private equity a lot. Generally, the founders and the management team that gets you from zero to something 100 million in revenue, they're usually not the same a lot of times, or you need to augment those folks to get from 100 to a billion. And so we have made a conscious effort, and this has been going on for several years now, to institutionalize the business, right? So we had a very strong family firm culture. It still exists today, but my job to get from 20 to 50 to 100 is processes, systems, all this stuff that you normally see, but still maintaining, at least from my opinion, what makes us different, which is everything we talked about.
Fantastic. Yeah, it would seem that what you're talking about, this succession, it's something that many firms don't get right. Either there's an ego, a big ego at the top that wants to stay there, even though they're getting later on in their years. It seems like you're making that conscious effort to not do that. And instead, I guess, what is the key aspect to ensuring you can institutionalize?
So you're 100% right. So as I mentioned, the firm was founded in 2004. At some point, the founders are going to do something else. Like generally, companies don't peak when the founders are like in their 70s or 80s, unless you're the U.S. government. Like that's different. Yeah. That's okay. But generally speaking, there's going to be a transition. And my view in life, and Ted's for sure, and Mike's and others, is there's one reality. You might as well live in it. So there's two ways you can do it. One is you can ignore the issue and then it becomes a mess. but why not just deal with it? Because it's inevitable. And so let's come up with kind of a structure and a transparency and a certainty. So we built the firm where you have the chief credit officer, you have the deputy. That person is the assumed successor to that position. Ted's the CEO, I'm the president. So listen, of course things can change, but there's an assumption there. And we've done that throughout all of the key places, whether it's the COO, whether it's, underwriting, whether it's so throughout the firm, we've built out the layers where, again, part of this Wendel transaction is, listen, I don't know if we're going to be around for 320 years from now, but not 5 years, not 10 years, but decades. And so we now have layers of the founders in their 60s, then folks like me in their 50s, and then folks below me in their 40s and 30s. So I think, listen, things may change in the future, but I think we've at least designed it to be resilient and to be here for the long run. And you got to make sure that the farm system, so to speak, is set up that way.
We're coming up on the tail end of the conversation. I have two final questions, but before I hit on those final ones, to those maybe company owners and executives that could be listening in and they're deciding on a partner, a capital partner on the debt side, what would you say? And then maybe there's like 3 or 4 that they're considering. Maybe you're in the mix. What would you say is the differentiating point about Monroe?
So listen, at the end of the day, this is still a people's business. So there are 2 groups of kind of folks that I've experienced. One is they focus purely on the economics, and market's market. So everybody kind of, if you get a deal, you're going to be within some reasonable band. Honestly, to me, that if I were in their shoes, I would look at the counterparty you're dealing with. And what I mean by that is, and how we differentiate ourselves is we have folks come in the office, they meet me, Mike, they can pick up the phone and call us if there's a problem. When things are good, there's no reason to talk. But when things are bad, then the question is, well, how are you going to act? What do you expect? And then you really see the true value of a partner. So again, 99 times out of 100, there's never an issue that you give them money, they give it back to you. That's how it's supposed to work. But generally, things don't go from A to B in a straight line, right? So what we focus on is kind of the personal aspect of it, because money is a commodity. But if they can understand and deal and understand how we will act in different scenarios, then they get comfort. And of course, our subject matter expertise, we've been around for 20 years. We've done over 1,000 deals. So we do have a pretty large database of kind of knowledge on different industries, which tend to be helpful for folks as well.
Excellent. Last 2 questions. One is, can you tell us about a person who has had a profound influence on you?
I was thinking about this. And listen, the obvious answers are the parents, right? So 99 times out of 100, you hear that. So that's a given. I will tell you, I am kind of in the camp where there have been a dozen people that I try to pick the best things that I want to emulate out of each one. So is it one person? No, but I can tell you the person who recruited me at Anderson, I just saw a post from LinkedIn. He's a piece of it, and that's 40 years ago. The first partner that was on my engagement at Arthur Anderson was another, the gentleman at private equity. So there are pieces along the way, probably 10 people, Ted, Mike, like there's others that I'm like, hey, listen, I like this piece of that. I'm going to see how I can incorporate it. So unfortunately, my answer is it's a hodgepodge of probably 12 different characters that I've dealt with over the years.
I like that. Last question. Can you tell us about a charity, cause, or other endeavor that you're passionate about?
So this is going to sound a little bit strange. So I always think somebody should have a side hustle. Works great, but like you need something else to keep your sanity. So my side hustle, and I started it after I graduated graduate school, is a martial art, Japanese fencing. It's called Kendo. So that has been a very big influence for me. People can Google it and check it out. But I've been doing it since 98. And so that is really something that I do. And listen, martial arts is something where a lot of it's mental as well as physical. And one of the reasons I got into it is the older you get, a lot of times you have a physical disadvantage. So I used to play basketball. You can't do that in your 60s. You get hurt. Or judo, or a lot of these things that wear down your body. Kendo was one where, and I won't spend a lot of time on it, but it's more about technique and mental focus and manipulation. And so I can spar with people in their 30s and I could do very well, even though they may be physically stronger than me, but it's because I know how to do things from a technique point of view or a manipulation point of view that they just don't know. So where experience matters. That's the side hustle.
Super interesting. Do you think there's like an element of the like mental aspect to the martial art that helps you in your professional life?
So yes, and I'll give you a very simple example. So in most Western sports, you go to basketball, there's a lot of talking. There's a lot of explaining. They walk you through things. In Eastern culture, so in martial arts specifically, and even in where we practice, you just repeat it. If you practice enough, there's no talking. Just go do it. And then, this adage of 10,000 hours and so. So the whole idea is it's a very different. The mental toughness is, listen, it's up to you and it's your responsibility to figure things out. Just practice. There's no substitute for practice. And that mentality, how does it apply at Monroe? This goes back to one of the things I said. Our general belief is, hey, listen, there's no tree that's not going to fall if you keep chopping at it. Like that's a mental toughness. This goes back to, you can be smarter or wealthier or whatever, but nobody should be able to outwork you. Like that's all in your head. Like your sheer desire to do something, you want to wake up in the morning and work out. Like that's something that's just discipline. So my short answer is, there is some aspects that carry over that I think are more than I realized, if you can believe that.
Excellent. It's a good note to end on. Zia, thank you so much for taking the time. This has been a great conversation.
Absolutely. Thank you so much for taking the time as well.